This video, created by the University of Missouri Agricultural Business and Policy Extension Program, provides information about how to determine cash rental rates from the perspective of a tenant. Farming tenants want to make a profit from producing agricultural commodities. Tenants may have other objectives, such as raising a family and helping society. To accomplish any of their objectives, their revenue must exceed all their costs, including the cost of renting property. There are several steps for determining leased property arrangements. The tenant first calculates their contribution to the production process, then studies published rental rates, makes an offer, and negotiates with the property owner to arrive at a mutually satisfying agreement. The first step for a tenant determining how much to pay for leased property is to create a budget detailing all revenues and costs. Most university extension divisions, including MU Extension, publish costs of production every year for major crops grown in that state. These are a great place to start when developing a workable rental agreement. Published cost of production estimates are for a representative farm in the state. It does not give the costs of production for any one farm. MU Extension publishes these budgets in spreadsheets that farmers can modify to reflect their actual inputs and prices paid. In a cash lease, the tenant is normally responsible for all operating costs, such as seed, fertilizer, chemicals, insurance, and fuel. The quantity of each input used times the price paid is the tenant's contribution to production. The tenant also contributes the ownership costs of machinery and general business overhead. Machinery ownership costs per acre change with the number of acres farmed. Machinery ownership costs per acre might decrease for a tenant adding acreage to his farm if he's able to farm the additional land without adding more machinery. When calculating how much to pay for rent, use current per-acre costs of owning equipment. Since machinery ownership costs per acre may be reduced by adding more land, tenants might use cost savings to offer the landowner a more attractive lease rate. The farming tenant's contribution is the sum of all operating costs and the ownership costs of any owned asset used in production. Many extension budgets put a real estate charge, or what might be paid as a fixed cash rent, in the ownership cost section of a budget. However, rent is the property owner's contribution, not the tenant's contribution. A reasonable real estate charge is settled by bidding and negotiation. Estimating expected revenue, should the tenant obtain the property, helps determine a potential reasonable real estate charge. Subtracting tenant contributions from expected revenue estimates the return to land and management. The return to land and management will be allocated to either land, an amount paid to the landowner as a lease, or management, an amount retained by the farming tenant as compensation for his work. The more that goes to land in the form of rent, the less that goes to management, and vice versa. The USDA and many universities publish the results of cash rental rate surveys. These surveys estimate what a tenant might expect to pay in rent. Cash rental rate surveys don't report specific rental rates at which tenants can make a satisfactory return on their management. The negotiation process is an effort to obtain the land at a rate that fairly recognizes the tenant's managerial contribution to production. Tenants may show this worksheet to the landowner to justify their rental rate offer. Negotiation requires the tenant to consider what the property owner wants, know the lease rate he can pay to obtain his desired return to management, and then arriving at a rate linking the desired outcomes of both tenant and owner.